The average American credit score is 715. Sounds fine. Here's the math nobody runs for you. A 715 score on a $400,000 mortgage costs you $89,000 more than a 780 score over the life of the loan. $89,000 for 65 points. Most people with a 715 think they have good credit. They don't. They have expensive credit, and they're making 10 invisible mistakes keeping them stuck there. Here's the part that should bother you more. About 60% of people who successfully raise their credit score are back below their starting point within 3 years. Not because the system is broken, because they fixed the number without understanding what actually created it. There's also one mistake on this list, number 3, that federal rule changes in 2023 made removable with a single phone call, but only if you know to make it. Most people don't. By the end of this video, you'll know all 10. You'll know which one is costing you the most. And you'll know what separates the people who fix their credit from the people who keep it fixed, which is the last thing I'm going to show you, and it's the thing most credit videos never get to. Let me start with the person who taught me what this actually looks like. Jessica is 34, Healthcare Administration, Columbus, Ohio. For 3 years, she made enough money to afford the life she wanted. Landlords and car dealers didn't see it that way. Rejected for apartments she could pay rent on in cash, offered car loans at rates that made her feel like a liability. She watched a house she'd already made an offer on go to someone else, not because she couldn't afford it, but because her paper score said she couldn't. She was at 580 PUI. And here's the part she told me she'd never said out loud before. She stopped opening her mail, stopped checking her bank app, started feeling like the kind of person who doesn't deserve nice things because every system she touched kept telling her she wasn't. She wasn't irresponsible. She was making 10 mistakes she didn't know were mistakes. 11 months later, she was at 760. She bought the house. But she almost quit at month 4, and I'll tell you why in a minute, because it's the moment most people give up and it's the reason most credit repair fails. First, the mistake that's tripping up almost everyone before they even begin. You check your credit score on your credit card app. It says 720. You apply for a mortgage. The lender pulls your score. It says 670. You didn't do anything wrong between those two checks. You're just looking at the wrong score. There are over 50 different credit scoring models. The one your bank app shows you is almost never the one lenders actually use. The score on your app is usually Vantage Score, free for the bank to provide, rarely used by anyone making a decision about you. Mortgage lenders use older FICO models that punish you harder for things newer models forgive. Jessica thought her score was 681. That's what her bank app showed. When she applied for her mortgage, it came back at 612. She lost the house she'd already made an offer on because she was managing a score that didn't exist. The fix: stop trusting free score apps as your real number. Once a year, pull your actual FICO scores from myfico.com. It costs about $20 for a one-time pull, worth it once a year, or get them directly from a lender. Know your real number before you need it, not after. Because knowing your score means nothing if you're making the next mistake. You have a credit card with a $10,000 limit. You charge $4,000 a month and pay it off in full. You never carry a balance. You never pay interest. You think you're doing everything right. You're killing your score. Here's the mechanic nobody explains. Credit card companies report your balance to the bureaus once a month, on your statement date, not your due date. If your statement date hits while that $4,000 is sitting there, your utilization gets reported as 40%. Anything over 30% tanks your score. Over 50% is devastating. Even if you pay it off 2 days later, the damage is done for that month. Jessica was charging $3,500 a month on a $5,000 limit card, paying it off in full every single month, never paid a penny in interest. Her utilization was being reported at 70% every month for 2 years. The fix has 2 parts. First, request credit limit increases on every card every 6 months. Higher limit, same spending, lower utilization. Second, and this is the move, pay your balance down before your statement date, not just before your due date. Get it under 10% of your limit before the statement cuts. Better yet, pay to 5 days before the statement, then use the card normally after. Your reported utilization drops to single digits. Score jumps within 30 to 60 days for most people. This is the one I mentioned at the start, the one a single phone call can fix. You went to the ER 2 years ago. Your insurance was supposed to cover it. There was a billing dispute. You moved. The bill got lost in the shuffle. Today, that $340 bill is in collections. It's on your credit report. Your score is 90 points lower than it should be. And you don't even know why. Medical debt is the number one source of collections on American credit reports, and most people have no idea they owe it. The hospital bills your insurance. Insurance pays most of it. The remaining $340 gets sent to an address you moved out of 6 months ago. 6 months after that, it's in collections. Jessica had 3 small medical collections totaling $618, each one from a separate visit where insurance paid most but not all. She had no idea any of them existed until a mortgage lender pulled her full report. Here's the rule change most people don't know about. As of 2023, paid medical collections must be removed from your credit report entirely, and medical collections under $500 are no longer reported at all. If your medical collection is under $500 and it's on your report right now, you can call the Bureau today and have it removed. That's not a maybe, that's federal law. For larger or more complex cases, some collections that are destroying your score right now may already be legally unenforceable or removable with a single conversation. The fix: pull your credit reports at annualcreditreport.com. Look for anything in collections. For medical collections, call the collector and offer to pay in exchange for written deletion. This is called pay for delete. Many medical collectors will agree, especially on older debts. Get the deletion agreement in writing before you pay a single dollar. For unpaid medical collections still on your report, dispute first, pay second. Half of these are reported with errors that get them removed entirely. That's your potential 50 to 100 point swing from one conversation. You have an old credit card you don't use, maybe a small annual fee, maybe you just want to simplify. You close it. You just hurt your score 2 ways at the same time. First, utilization. Say you have 3 cards with $5,000 limits, $15,000 total available credit. You're carrying $2,000 in balances. Utilization is 13%. Excellent. Close one card. Now you have $10,000 available with the same $2,000 balance. Utilization jumps to 20%. You did nothing different. Your score just dropped. Second, history length. 15% of your FICO score is the average age of your accounts. That old card was anchoring your average upward. Once closed, it falls off your report in about 10 years and takes its history with it. Jessica closed her oldest card, a Capital One card from college, because it had a $39 annual fee. Her score dropped 47 points in 2 months. She paid $39 to lose 47 points. The fix: never close old cards unless the annual fee is genuinely painful. If it's small, keep paying it. It's the cheapest credit maintenance you'll ever buy. Better option: call the issuer and ask them to product change the card to a no-fee version. Same account, same history, no fee. If you have to close something, close the newest card. Protect your account age like it's an asset, because it is. Stop the video for 10 seconds. I'm serious. Open your bank app. Look at the credit card you use most. Find 2 numbers, your current balance and your credit limit. Divide the balance by the limit. If that number is above 0.30, meaning if your balance is more than 30% of your limit, you are losing points every single month you don't fix it. Not because you missed a payment, not because you did anything wrong, because of one timing mechanic the system never explained to you. That's the gap between what you've been told and what the system actually does. Most of what's coming next works the same way. Small mechanics, invisible damage, free fixes if you know they exist. 5 more mistakes. The last one is the reason 60% of credit fixes don't last. You forgot to pay your credit card one time. You meant to, got busy, the auto pay didn't go through, 30 days passed. The creditor reports you as late to all 3 bureaus. One 30-day late payment can drop your score 80 to 110 points overnight, and it stays on your report for 7 years. Payment history is 35% of your FICO score, the single largest factor. One missed payment can erase years of perfect history. Jessica missed a $42 minimum payment on a Best Buy financing card during a move. Her score dropped 96 points. This was her month 4, the moment I mentioned at the start. She'd spent 3 months doing everything right, paying down utilization, disputing errors, requesting limit increases, and she watched 4 months of work disappear because of a $42 bill she didn't know existed. She told me she sat in her car in a parking lot for 40 minutes that day, deciding whether to give up. She didn't. And the reason matters, because she made one phone call that most people don't know they're allowed to make. The fix is non-negotiable. Every single bill on autopay. Every one. Minimum payment at minimum. Yes, even bills you're disputing, pay them and dispute later. The damage from a late payment is too severe to risk. If you miss a payment, call the creditor within the first 29 days before it hits 30. Ask for a goodwill adjustment, a script that works. I've been a customer for X years. This was an isolated incident. I'd like to request a goodwill adjustment. If you have a history of on-time payments, they'll often remove the late mark entirely. If it already hit your report, call anyway. Ask for goodwill removal. Be polite. Be persistent. About 30% of these requests succeed with a clean prior history. That's the call Jessica made from the parking lot. They removed it. Her score came back in 6 weeks. The FTC estimates 1 in 5 credit reports contains a meaningful error. That's 20% of Americans walking around with damaged credit because of bureau mistakes, not their own. Wrong account balances, accounts that aren't yours, late payments you actually paid on time, collections that should have aged off. Identity mixed up with someone who has a similar name. These errors crush your score, and the bureaus will not fix them unless you force them to. Jessica found a $1,200 collection from a cable company she'd never had service with. Same name, different person. Took 90 days to dispute and remove. Her score jumped 54 points the day it came off. The fix: pull all 3 reports. Read every single line. Anything that looks wrong, dispute it. Free at Experian.com, Equifax.com, and TransUnion.com. Under the Fair Credit Reporting Act, the Bureau has 30 days to investigate. If they can't verify the item with the original creditor, they must remove it. Based on reported outcomes, roughly 40% of disputes result in removal or correction. Here's the move most people don't know. Dispute by certified mail instead of online. Online disputes are processed by software. Mailed disputes go to humans, who often remove items rather than investigate, because investigation takes more time than the debt is worth. Slower, higher success rate. This is the single highest return activity in all of credit repair. 1 hour of your time, potentially worth 50 to 100 points if you have errors on your report. You're at checkout. The cashier offers 20% off if you open a store card. You think, why not? I'll save some money today. You do it 3 more times over the next 6 months. 4 new cards, 4 hard inquiries, 4 new accounts dropping your average account age. Your score didn't go up, it went down. Here's the mechanic. Every time you apply for credit, the lender pulls your report. That pull, called a hard inquiry, drops your score between 5 and 10 points. It stays on your report for 2 years. 4 inquiries in 6 months is a pattern the scoring models read as financial stress, not savvy shopping, stress. Jessica applied for 4 store cards between October and March. The 20% off felt like wins in the moment. She spent $200 in savings to create a $2,400 loss in borrowing costs over the next 2 years. The fix has 2 parts. First, be ruthless about new applications. Every hard inquiry should be a deliberate decision, not a checkout impulse. Ask yourself before every application, is this account worth 5 to 10 points in 2 years on my report? Most store cards aren't. Second, and this matters if you're shopping for a mortgage or car loan, multiple inquiries for the same type of loan within a window of 14 to 45 days are counted as a single inquiry by most FICO models. Older models use 14 days. Newer ones give you 45. To be safe, keep all your rate shopping inside 2 weeks. The system was designed to let you comparison shop without penalty. Use that window intentionally. Apply to 5 mortgage lenders in 1 week. It counts as 1 inquiry. Apply to 1 per month for 5 months. It counts as 5. Same information, different timing, different score. You've been paying down debt, paying on time, keeping utilization low. Everything is moving in the right direction, but your score tops out at 740 and nothing moves it higher. Most people assume they've hit a ceiling. They haven't. They're missing a category. FICO scores you on 5 factors: payment history, utilization, account age, new inquiries, and credit mix, meaning the types of credit you have. 10% of your score is whether you have both revolving credit, cards, and installment credit, loans. Most people only have cards. If you have no installment loans on your report, the scoring model can't fully evaluate you. Not because you're risky, because you're incomplete. The system doesn't reward people who avoid debt. It rewards people who manage multiple types of debt responsibly. Jessica's score was stuck at 740 for 4 months. She'd done everything else right. Added a credit builder loan through Self. Inc., $25 a month, 12 months, fully secured, and her score crossed 760 within 3 months. Total cost, somewhere between $15 and $50 depending on the plan. Gained 20 points that moved her into the best mortgage rate tier. This isn't personal finance advice. It's scoring mechanics. The game has rules, and this is one of them. You only need to do this once. After one installment loan paid in full, it stays on your report for 10 years. If your score has been parked in the 720 to 740 range for months and nothing is moving it, this is almost certainly why. You have a credit card you don't use much. You put it in a drawer. You think, out of sight, out of mind. No spending, no risk. Smart thinking. Wrong execution. Card issuers monitor account activity. If a card shows no transactions for 12 to 24 months, the issuer can close it without warning, no notification, no grace period, closed by issuer. Two things happen immediately. Your available credit drops, utilization spikes, your account age average drops, history score takes a hit. Jessica had a Discover card she'd had since 2015. 8 years of history, $8,000 in available credit. She kept it in her wallet but never used it. She had a rewards card she preferred. The issuer closed it in month 7 of her credit rebuild. Overnight, she lost $8,000 in available credit. Utilization jumped from 22% to 41% in a single day. Her score dropped 38 points from a card she didn't even know was at risk. The fix is simple and permanent. Set a recurring calendar reminder every 3 months. Pick one small purchase per inactive card, a streaming subscription, a gas station stop, a single grocery item. Use the card. Pay it the same week. Done. 5 minutes of setup protects everything you've built from disappearing while you're not looking. Everything I've shown you so far is mechanical. Find the mistake, run the fix, watch the score move. What I'm about to tell you is the difference between Jessica today and the 60% of people who fix their credit and lose it again within 3 years. This isn't a mistake you make once. It's the mistake that undoes all the others, and most people make it without realizing it exists. The reason most credit fixes fail is not information, it's infrastructure. People learn what to do, they do it, the score moves, they stop paying attention. Life gets busy, the utilization creeps back up, the inactive card gets closed. The autopay misses one payment, the hard inquiry happens at checkout without thinking. 18 months later, they're back where they started, and they don't know why. Jessica didn't just fix her credit, she built 3 systems that made it nearly impossible to break. System 1. Monitoring. She set up free alerts through all 3 bureaus: Experian, Equifax, TransUnion. Any new account, any hard inquiry, any balance change over $500 triggers a notification. She catches errors in days, not years. System 2. Freeze. When she's not actively applying for credit, her file is frozen at all 3 bureaus. Nobody can open credit in her name. Nobody can pull her report. You can thaw it online in under 5 minutes when you need to apply for something, then refreeze when you're done. Free at all 3 bureaus. 15 minutes of setup. One of the most underused financial protections available. System 3. Audit. On the first of every month, she checks 3 numbers: current utilization across all cards, any new inquiries, average account age. Takes 4 minutes, catches problems before they compound. The score is not the asset, the system is the asset. Anyone with 30 days and a credit card can move a score. The people who keep it moved are the people who built the structure underneath it. Jessica's mortgage payment is $340 a month less than it would have been at her old score. Over the life of the loan, that's $122,000. She didn't get lucky. She didn't make more money. She found the 10 mistakes she didn't know were mistakes and built a system that protects her from making them again. You can do the same thing tonight. Pull your credit reports at annualcreditreport.com. Free. All three bureaus. Look for anything in collections, anything that looks wrong, anything you don't recognize. Check your utilization on every card. Divide balance by limit. Anything over 30% is costing you points right now. Set every bill on auto pay for at least the minimum. Tonight. Not this week. Tonight. Those three things, done in the next hour, are worth more than any credit repair service you could pay for. Don't be Jessica from 11 months ago. Be Jessica today. Which of these 10 was the mistake you didn't know was a mistake? Leave it in the comments. I read every comment for the first 48 hours after a video goes up, and the patterns tell me what to make next. If this video saved you from one of these 10, the best thing you can do is send it to one person who's stuck at the same score they've been at for 2 years. They'll know exactly why you sent it.